$17 billion. That's how much cash the Federal Reserve quietly injected into an unnamed bank at 8 o'clock in the morning on December 26, 2025, the day after Christmas. While most of America was still sleeping off turkey dinners and unwrapping presents, someone on Wall Street was in deep trouble. The identity of that borrower remains classified under Federal Reserve disclosure rules. We won't know who needed emergency funding until 2027, but the timing tells us everything we need to know. This wasn't routine. This wasn't planned. This was a financial institution in crisis, tapping the Fed's emergency window during the quietest trading week of the year. And that was only the beginning. 6 days later, on December 31st, the New York Fed executed the largest single-day repo operation in American history, $74.6 billion, secured by $31.5 billion in Treasury bonds and $43.1 billion in mortgage-backed securities. The previous record of $50 billion had been set just 2 months earlier on Halloween. Now they had shattered it by nearly 50%. Connect these numbers. Halloween, $50 billion. Day after Christmas, $17 billion. New Year's Eve, $74.6 billion. In just 61 days, the Fed had injected over $140 billion into banks that couldn't fund themselves in the private market. The official explanation? Year-end liquidity management, routine operations, nothing to see here. But here's what they didn't mention in the press releases. On December 10th, just 16 days before that mysterious $17 billion injection, the Federal Reserve had quietly removed the $500 billion cap on its Standing Repo Facility. The announcement was buried in technical language that not a single major financial news organization reported. The new policy allowed individual banks to access up to $240 billion per day in emergency funding. Unlimited, uncapped, available on demand. Why would the Fed make such a dramatic policy change right before the holidays? There's only one logical answer. They knew what was coming. They were preparing for something, and that something has a name. Silver. The math doesn't lie. On January 1st, 2026, while COMEX futures screens showed silver trading at $72 per ounce, physical bullion dealers in Tokyo were selling the same metal at $130, an 80% premium. In Dubai, similar prices. In Shanghai, the premium had exceeded $8 per ounce throughout late December. Indian buyers were paying $5 above COMEX just to secure any metal at all. This isn't a market. This is a confession. The paper price and the physical price have completely decoupled. Two different realities existing simultaneously. One controlled by futures contracts and margin requirements. The other determined by actual supply and actual demand for actual metal. The question is why? And the answer leads directly back to those emergency Fed injections. For decades, the silver market has operated on a simple premise. Paper contracts represent claims to physical metal. When you buy a silver futures contract, you're theoretically buying the right to take delivery of 5,000 ounces of actual silver. In practice, most traders never take delivery. They roll their contracts forward, speculating on price movements without ever touching the metal. This system works as long as everyone believes the metal exists, as long as no one actually demands delivery. But what happens when they do? On October 8th, 2025, India placed an order for 1,000 tons of silver through the London market. 1,000 tons. That's 32 million ounces. A routine order for one of the world's largest silver consumers. The London market froze. Silver lease rates, which had been sitting at 0.25%, exploded to 200% overnight. 200%. That's not a typo. The cost of borrowing silver increased 800-fold in a matter of hours. Traders withdrew from the market entirely. The Swiss refiner Metalor, which operates in 17 countries, announced they would not return until January 2026. The London Bullion Market Association reported 844 million ounces of silver in its vaults, nearly 24,000 tons. Yet the market couldn't deliver 1,000 tons. The numbers didn't add up. They never did. The real story was just starting. Within weeks, the delivery crisis spread to New York. COMEX registered silver, the category of metal actually available for delivery against futures contracts, has been in free fall since February 2021. The numbers are stark. In December 2025, over 60% of all registered silver was claimed for delivery in just 4 trading days. 47.6 million ounces. Gone. The COMEX vault drain is accelerating at a pace that suggests something structural has broken. Since 2020, COMEX registered silver has declined by 73%. 3/4 of the deliverable supply has vanished, and the remaining metal is being claimed faster than ever before. On January 7th, 2026, the first delivery report of the new year revealed something extraordinary. Holders of 1,624. January silver contracts demanded immediate delivery of 8.1 million ounces. That's unusual for a minor contract month. But what happened next was even more unusual. After those deliveries settled, Open interest in January contracts actually increased by 1,431 contracts. More buyers stepped in after delivery, not fewer, more. JPMorgan issued 99% of that metal. The bank that spent a decade as the largest silver short in history, the bank that paid nearly $1 billion in fines for precious metals manipulation, is now delivering physical silver as fast as it can. Their vault is hemorrhaging metal. 3 million ounces lost in a single month, 1.5% of their entire stockpile. What changed? Reports began circulating in late 2025 that JPMorgan had completely reversed its position, from a 200 million ounce paper short to a 750 million ounce physical long, the largest silver stockpile in history. The bank that suppressed prices for years is now positioned to profit from the highest prices imaginable. The data supports this theory. Throughout 2025, JPMorgan's behavior in the delivery market shifted from issuing shorts to stopping longs. They went from selling paper promises to accumulating physical metal. The first delivery report of 2026 shows them aggressively taking maximum physical delivery, a complete strategic pivot. But here's what the JPMorgan story doesn't explain. If the world's largest bank has flipped long, who is still short? Who owes all that metal? And how do they plan to deliver it? The answer is, they can't. And that's why someone needed $17 billion on December 26th. The mechanics of a short squeeze in physical commodities are different from stocks. When you short a stock, your losses are theoretically unlimited, but you can always buy shares in the open market to cover. When you short physical silver, you're promising to deliver actual metal, metal that has to come from somewhere, metal that increasingly doesn't exist at the promised price. The December 2nd bank participation report showed 8 major U.S. banks collectively net short 212 million ounces of silver. At the current COMEX price of $72, that's a notional position of $15 billion. But the COMEX price isn't real anymore. The physical market in Asia is telling us silver is worth $130. At that price, the same position represents a loss of over $12 billion. $12 billion in unrealized losses. Spread across 8 banks, someone is going to fail the margin call. And that's exactly when the CME stepped in. On December 26, 2025, the same day as the $17 billion Fed injection, the Chicago Mercantile Exchange announced Advisory Number 25393. Effective December 29th, initial margin requirements for March 2026 silver contracts would increase to $25,000 per contract, up from $20,000 just weeks earlier, a 25% increase overnight. Then on December 31st, they did it again. The second margin hike in less than a week. Higher collateral requirements mean leveraged traders must either post more cash or liquidate their positions. For those betting on rising silver prices, this was a forced exit. Sell your position or come up with more money. Most retail traders don't have the capital. They sell. Silver crashed from $84 to $73 in a single session. A 15% decline. Mission accomplished. The playbook is familiar. In 1980, when the Hunt brothers accumulated over 200 million ounces of silver and pushed prices toward $50, the COMEX implemented Silver Rule 7, emergency margin hikes designed to break the rally. Silver collapsed from $50 to $10 in 2 months. The Hunts went bankrupt. In 2011, when silver again approached $50, the CME raised margins 5 times in 9 days. Another 30% crash. The pattern is undeniable. Every time silver threatens to expose the paper market's inadequate backing, the exchange changes the rules. Higher margins force liquidation. Prices fall. The shorts survive another day. But something is different this time. In 1980 and 2011, the silver rally was driven by speculation. Paper traders bidding up prices without any interest in physical delivery. When margins increased, they folded. The physical market wasn't tight enough to support the prices. Today, the opposite is true. The physical market is screaming. Tokyo at 130, Dubai at 130, Shanghai at $8 over COMEX. Indian buyers paying any premium just to get metal. The speculation isn't driving prices up. Physical scarcity is. And on January 1st, 2026, that scarcity got much worse. China implemented the most aggressive precious metals export controls since rare earth restrictions began. Under the new policy, only 44 companies are licensed to export silver. To qualify, a firm must have annual production capacity of at least 80 tons. This requirement eliminates hundreds of smaller and mid-sized exporters who had served as key suppliers to global industrial users. China controls 60 to 70% of the world's refined silver supply. The new licensing system effectively allows Beijing to turn off the tap whenever they choose. Solar panel manufacturers, semiconductor companies, electric vehicle producers, artificial intelligence hardware builders, they all need silver. And now they all need China's permission to get it. The timing wasn't coincidental. Throughout 2025, Shanghai silver inventories collapsed. Over 300 tons disappeared from Shanghai gold exchange vaults in October alone. The stocks dropped to their lowest level since 2016. That metal didn't evaporate. It flowed west into London and New York as arbitrageurs exploited the premium differential. But that arbitrage only works when China allows exports. Starting January 1st, the flow has been restricted. Western markets that were already tight now face genuine supply disruption. The metal simply isn't coming. Industrial demand doesn't stop because prices are high. Solar panels still need silver paste. Electric vehicles still need silver contacts. Data centers still need silver-coated connectors. These buyers are price inelastic. They will pay whatever it takes to keep production lines running. In 2025, industrial consumption exceeded 60% of annual mine production. The Silver Institute projects continued deficits for the foreseeable future. There is no supply response available. New mines take 7 to 12 years to develop. There is no surge of recycled silver coming. Only 180 million ounces were recovered in 2025, against 600 million ounces consumed. The math doesn't lie. Demand exceeds supply. Inventories are falling. Exports are restricted. And the paper market is pretending the price is $72 while physical buyers pay nearly double. Something has to give. The Federal Reserve understands this. That's why they removed the cap on emergency lending 2 weeks before Christmas. That's why they've injected over $140 billion into banks since Halloween. They're not solving the problem. They're managing it, buying time. Cash solves margin calls. The Fed can print $17 billion, or $74 billion, or $700 billion if necessary. They can keep the banks technically solvent. They can prevent the immediate failure. But cash doesn't solve the metal problem. You can't print silver. When a futures contract expires and the buyer demands delivery, someone has to produce 5,000 physical ounces. The clearinghouse doesn't accept dollars. It demands metal. COMEX has 127 million ounces of registered silver remaining. At the current pace of deliveries, that could be claimed in weeks, not months. And when the registered category is depleted, only 2 options remain. Either convert eligible silver to registered, which requires the actual owners of that metal to agree, or declare force majeure and settle contracts in cash at the paper price. Cash settlement would be the end of COMEX as a price discovery mechanism. It would prove that the futures market was never backed by real metal. It would send physical premiums parabolic as buyers realize the only way to own silver is to hold it in your hands. The London market is no closer to salvation. The LBMA claimed 844 million ounces in vault storage, yet they couldn't deliver 1,000 tons when India asked. The implication is obvious. Most of that silver is allocated to specific owners. It's already claimed. It's not available for delivery no matter what the headline number says. This is why the physical market is diverging. Buyers who need actual metal are discovering that the price on their Bloomberg terminal has no connection to the price required to secure supply. The COMEX price is a fiction. The real price is whatever someone with physical silver will accept. In October, that was a few dollars premium. In December, $8 to $10. By January 1st, Asia was paying $60 over COMEX. The premium is the market's way of telling the truth. JPMorgan saw this coming. Their pivot from short to long wasn't altruism, it was survival. They accumulated 750 million ounces of physical silver, worth over $40 billion at the suppressed COMEX price. At the Asian physical price, that same stockpile is worth nearly $100 billion. They positioned themselves on the right side of the squeeze. Other banks were not so prescient. The December bank participation report shows substantial net short positions among commercial banks that are not JPMorgan. Those banks are the ones tapping the Fed window. They're the ones receiving emergency cash injections to meet margin calls. They're the ones praying the CME margin hikes can push prices low enough to cover. But margin hikes are a temporary measure. They force out leveraged speculators. They don't change physical supply and demand. After every margin-induced crash in history, silver eventually recovered and exceeded its previous highs. 1980 led to 2011, 2011 led to 2025. Each time, the fundamentals grew more bullish. The world produces roughly 850 million ounces of silver annually. It consumes over 1 billion ounces. The deficit has persisted for 4 consecutive years. Above-ground stockpiles are being depleted. The United States, which imports 64% of its silver needs, added the metal to its critical minerals list for national security purposes. This isn't speculation. It's mathematics. Industrial civilization requires silver. There isn't enough. And the institutions responsible for price discovery have been lying about supply for decades. The moment of truth is approaching. Either the paper market capitulates and prices reset to physical reality, or the paper market defaults and admits the contracts were never backed by real metal. There is no third option. The Fed can delay this reckoning. They've proven they're willing to inject unlimited liquidity to keep the banking system functioning. But each injection is an admission of stress. Each emergency loan is a confession that someone can't meet their obligations. $17 billion on December 26th, $34 billion on December 28th, $74.6 billion on December 31st. The pattern is clear. The amounts are escalating. The crisis is accelerating. Meanwhile, sophisticated money is repositioning. ETF investors are converting paper holdings to allocated physical. Institutional funds are moving metal from London to private vaults in Singapore and Zurich. Central banks are buying gold at over 1,000 tons per year, quietly accumulating the only monetary asset that can't be printed. The message is consistent. Those who understand what's happening are securing physical metal. Those who don't are holding paper, claims that may prove worthless. Silver at $130 in Tokyo, while COMEX shows 72, is not a market inefficiency. It's a warning. The paper system is breaking. The physical system is revealing the truth. The gap between them is the size of the lie. When India couldn't get 1,000 tons from London, that was a warning. When lease rates exploded 800-fold overnight, that was a warning. When COMEX registered, silver dropped 60% in 4 days, that was a warning. When the Fed removed caps on emergency lending and immediately started injecting record amounts, that was a warning. The warnings are everywhere for those willing to see them. The question isn't whether the silver market will reprice. The question is how. Will it be a controlled repricing where paper and physical gradually converge over months as the COMEX price rises to meet Asian reality? Or will it be a disorderly collapse where a failed delivery triggers a cascade of defaults and the paper market simply ceases to function? The Fed is betting on controlled. They're providing unlimited liquidity to ensure no bank fails spectacularly. They're hoping the CME margin hikes can manage the price ascent. They're praying China doesn't tighten export restrictions further. But hope isn't a strategy, and the math doesn't care about central bank prayers. Every day that passes, more metal leaves COMEX vaults. Every day, industrial users secure more supply at premium prices. Every day, the gap between paper fiction and physical reality grows wider. Every day, the shorts fall further behind. $17 billion bought someone another week, maybe 2. But it didn't buy them silver, and silver is what they owe. The first delivery report of 2026 showed JPMorgan issuing nearly every ounce demanded. They're delivering. They have the metal. But their counterparties are receiving it, not returning it. The flow is one direction, out of the vaults, into private hands. When those vaults are empty, the game ends. No amount of Fed money can change that outcome. They can manage the process, they can soften the landing, but they cannot prevent the repricing that mathematics demands. Physical silver is going to reach the price that clears the market. That price is not $72. Tokyo already told us it's $130. Shanghai confirms it's significantly higher. The industrial users bidding up premiums confirm it's higher still. The story isn't over. The January 7th delivery report showed something unprecedented. Demand rising after delivery. More buyers entering after seeing metal actually change hands. Confidence that physical exists is creating more demand for physical. This is the opposite of a bubble. In a bubble, prices rise on speculation until the speculative demand exhausts itself. In a physical squeeze, prices rise because actual buyers need actual metal and there isn't enough. The demand is real, the supply is inadequate, the price must adjust. What we're watching is the paper market's last stand. Margin hikes. Emergency lending. Coordinated smashes. Every tool in the playbook is being deployed, and yet the physical premium persists. The deliveries continue. The vaults drain. Someone on Wall Street needed $17 billion the day after Christmas because their silver short was killing them. Someone else needed $34 billion 2 days later. Someone needed $74.6 billion on New Year's Eve. The desperation is measurable in dollars and cents. The Federal Reserve has chosen to bail out the shorts. They've chosen to extend credit rather than allow failure. That decision has consequences. It means the repricing takes longer. It means the pain is distributed over months rather than days. But it doesn't mean the repricing won't happen. Every ounce of silver that leaves COMEX brings the endgame closer. Every industrial user who secures supply at premium prices validates the new reality. Every retail investor who converts paper to physical removes metal from the system. Every central bank gold purchase signals where reserve managers see the world heading. The signals are everywhere. The data is clear. The math is undeniable. $17 billion wasn't a solution. It was an admission. The silver shorts are drowning and the Fed is keeping their heads above water, for now. But the metal is leaving. The premiums are widening. The vaults are emptying. And math always wins. The next chapter of this story will be written in delivery reports and vault inventories. Watch the COMEX registered category. Watch the Shanghai premiums. Watch the Fed's repo operations. These are the metrics that matter. Gold is already signaling the path forward. At $4,400 per ounce, up 71% in 2025, the yellow metal has delivered its best performance since 1979. Central banks purchased over 750 tons in 2025 alone. JPMorgan forecasts $5,000 by the fourth quarter of 2026, but silver has outperformed gold by a factor of 2, 150% gains in 2025. Smart money is rotating from gold to silver, recognizing that the white metal offers superior leverage to the same monetary dynamics. China's only silver fund was forced to halt new retail inflows after a buying frenzy drove prices 60% above the actual value of holdings. That's not speculation, that's desperation. That's the fundamental reality the paper market is fighting. Every margin hike, every emergency injection, every coordinated smash is an attempt to delay the inevitable, to buy time, to manage the transition. But transitions cannot be managed forever. Eventually, the physical market takes control. Eventually, the price reflects reality. We are closer to that moment than most people realize. The Fed knows it. That's why they removed the caps. The CME knows it. That's why they're hiking margins twice a week. JPMorgan knows it. That's why they flipped from the largest short to the largest long in history. The only people who don't know it are the ones still watching the COMEX price and believing it means something. It doesn't. Not anymore. The real price of silver is being set in Tokyo, Dubai, Shanghai, and Mumbai. It's being set by industrial buyers who need metal and will pay whatever it takes. It's being set by investors who understand that paper claims are worthless if the metal doesn't exist. That price is $130 and rising. The $17 billion bailout was just the beginning. There will be more, larger amounts, more frequent injections. The Fed is committed to keeping the system alive, but every dollar they inject is a confession that the system is dying. Watch the numbers, follow the metal, trust the math. The silver squeeze of 2026 has begun, and it will not end until the paper market surrenders to physical reality. That day is coming, faster than anyone wants to admit. The Fed can print money, the CME can raise margins, the banks can coordinate their selling, but none of them can print silver, and silver is what they owe. This isn't a fight they can win, because this isn't a fight against speculators. It's a fight against geology, against industrial necessity, against mathematics, and math always wins.